Well, I made definitely a few mistakes in my underwriting. The first thing that I made a mistake on was trusting the opinion of people who were incentivized for me to purchase the property. The
Mm.
real estate broker is incentivized, the property manager is incentivized, the general contractor is incentivized. If I purchase and I execute the business plan that I put forth, they'll all make money regardless of how the asset performs. The property manager makes money on revenue. The broker makes money when she sells it, regardless of what happens after that. And the general contractor makes money on the repairs that you've planned, regardless of your performance. So when everyone tells you, oh yeah, the rents are certainly going to be $700 a unit, that's market rate. And you are using that as your foundation to underwrite. You could be the best underwriter in the world with the best spreadsheets and the best if-then calculations, whatever, with this very sophisticated, very detailed plan. But precision does not equal accuracy. Your due diligence dictates that you have to go out and trust but verify that information. And I don't think I did enough of that. So I over-assumed what my rent potential was. And yes, I could get $700 a unit, but that meant that I was going to have units that were vacant, that were going to have to be turned, that were going to have a lot more capital out there. I couldn't just push it from $350 a unit to $700 a unit with the same tenant within 1 month. So I was not prepared to boil the frog, as you say, to slowly improve the property and slowly improve the rents. I assumed this would all be done in 12 to 18 months, which was not the case. I think the second challenge I had was the deferred maintenance was correctly estimated, but the amount of working capital I gave myself was not correctly estimated. I had some trouble finding a lender because I was an out-of-town investor and because the portfolio of assets being sold were non-contiguous. Non-contiguous means that the parcels were not located next to each other, that they were, let's say, a mile away from each other, two different locations. As a result, this $1.5 million property was really two $750,000 locations, which became too small for an institutional lender. So while I had targeted $1.5 million deal that looked good on paper because of my faulty underwriting, I really had an asset that required a regional lender, a local lender, but I was not a local guy, so I had difficulty getting a local loan. Consequently, I had to take out I had to have a $150,000 operating reserve. Someone finally said, yes, we'll give you a loan, but here's our requirements. And I had to compromise. But I had already raised money with preferred returns. I'd already closed it under the assumption of how much money I was going to raise. If I raised more, it was going to reduce the internal rate of return for the investors I already had there. And that was unacceptable to me. So I came up with some creative stuff. I got some seller financing that, 0% for a couple of years for my seller, took some more money out of pocket, 0% interest loan, kind of squeezed the numbers a little bit on working capital, was a little bit too optimistic, and as a result ran out of money. So ultimately, I didn't have the money that I needed to improve the property to get to rents that I couldn't have reached anyway. So those were my two mistakes. It wasn't a dead deal. I didn't lose the investor's return, but I realized very quickly that I was not going to be able to produce cash flow. And the psychology of sending a check is very important, no matter how small. And I couldn't do that. So I knew that I needed to exit this as quickly as possible. Luckily, it was 2014 when I purchased it, so appreciation was occurring regardless of how I had purchased the property. So I was able to exit the opportunity in a mediocrely positive manner for all of my investors after 3 years of operating it. I learned a lot, learned a ton, didn't really change my personal situation, but I did show some folks how I operate when things don't go according to plan. And I think that only improved the relationships for future investments.